Hi everyone and welcome to this video. So the entire world is currently discussing the consequences of a potential conflict between Russia and Ukraine. In this video, we'll try and understand how this conflict can impact the Indian stock markets. In the end, we'll also see what an Indian investor should do under the current circumstances. So before moving to understand how equities behave during the times of war, let us understand the movement of some of the other asset classes. So for example, in case of gold, the prices of gold move upwards because most of the investors feel gold is more secure than equities and they rush to buy gold during the times of war. Similarly, the prices of crude oil also increases because of supply related shocks. In the case of Russia and Ukraine conflict, prices of some of the metals like aluminium and copper would also go up because Russia is one of the top suppliers of these metals in the global market. Now you would ask that Prashant, if it is so easy to understand the movement of asset classes during times of war, what is so challenging about stock markets which makes it difficult to understand its movement during war? Now stock markets are very volatile and unpredictable, and it is anyway very difficult to understand its movements. At times of war, this becomes even more complicated. Furthermore, there are so many opinions currently in the market that it is very difficult to understand the composite effect a war can have on stock markets. So in this video, we'll analyze data and try to see how stock markets have behaved historically at times of war. Now there are three phases in any war, and to understand the impact of wars on stock market, it is important to understand how the stock market behaves in each of these three phases. But let's first understand what these three phases are. So in the normal world, where there is peace and harmony, something happens which leads to tensions and conflicts. Now, this event, which leads to tensions and conflicts, is called the inciting event. This is followed by the pre-war phase till the war actually outbreaks. Once the war outbreaks, after some time, the peace and harmony returns, and that is the post-war phase. Now, let's look at the stock market data for each of these three phases. Now, in the pre-war phase, there is an inciting event, which basically leads to tensions and conflicts. Now on the screen, you will see a list of 20 inciting events from 1940 to 2020. And what was the impact of these events on the stock market? So this column basically has the one-day impact of the event on the stock market. That if the stock market went down, how much did it went down? The next column is basically the total drawdown. That is, once the stock market started going down, till what depth did it go? So this basically is the maximum negative impact of this particular event on the stock market. The next column is basically calendar days to the bottom. So how many days did the stock market take to reach to its bottommost level? That is the total drawdown. And finally, after the stock market reached its bottommost level, how many days did it take to come back to the same level to which it was trading before the inciting event? Now, if you look at all these events, you will realize that all these events had the potential to cause a major global conflict. But despite that, if you look at its impact on the stock market, it was not as high as one might expect. Now, if you look at the average of all these events and look at the bottommost row in yellow, you will see numbers that are very low. For example, the one-day impact of all these events on an average was just 1.2%. That means on the day these events happened, the stock markets only went down by minus 1.2%. Similarly, the total drawdown, the total negative impact was just 5%. It took 22 days only for the market to reach these minus 5%, and after that, the market started recovering, and within 47 days, the market recovered to its pre-inciting event levels. So that means if you add 22 and 47, in around 69 days, the market actually recovered from the shock of this inciting event. Now, even for an event as large as the US terrorist attacks, the markets only went down by 11.6%. And within a matter of 40 days, 11 days for going down and 31 days for recovery, the market recovered completely to its pre-event level. What this table shows in summary is that the stock markets react negatively to such trigger events. But the effect on stock market is not very high. Moreover, the effect is ephemeral and short-term in nature. Within 70 days, the markets recover from whatever notional losses it undergoes. Let's now move to the second phase of the war, that is, when the war actually outbreaks. Now, this is where there is a lot of confusion in terms of how the stock markets react when the war outbreaks. But the most accepted theory is based on the research paper that you see on your left, which is the war puzzle, contradictory effects of international conflicts on stock markets. Now, this is a big research paper, and I did some reading over the weekend to go through it entirely. In this video, I'll present you a brief summary of what this paper says. But if you like this kind of detailed analysis, please press the like button so that I can continue making such videos. In summary, what this paper says is that if the war outbreak is sudden, then the impact on the stock markets is negative. But if the war is preceded by an extended pre-war phase, then the stock markets are impacted positively. Now, this is super counterintuitive, and we'll dive deeper into data to look at this insight. Now, the table on the right shows the performance of US stock market at times of war. If you look at the first two rows, in the first row, you will see the average returns generated by the US stock market between 1926 and 2013. In the second row, you will see the returns generated by the US stock market during the times of war. Now, if you look at this number and this number, you will realize that both large cap stocks and small cap stocks have actually given better returns during war. Now, you would ask, why does this strange phenomena happens? And why does an outbreak of a war increases stock prices? Now, this happens because when a war has an extended pre-war phase, the investors have already overreacted to the trigger event. By the time the actual war outbreaks, the markets were already adjusted, and in fact, the outbreak of a war was then seen as a signal for quicker resolution of conflicts and the reduction in uncertainty. Let us now look at the third and the final phase of the war, the post-war phase, when the peace and harmony returns. Now, what you see on your screen is the data for US markets, and what we can see is that after the major wars, there has been a major rally in the markets. So, for example, this is World War I, and you will realize that after World War I, the markets rallied by 504%. Similarly, after World War II, the markets rallied by 523%, and after the Vietnam War, the markets rallied by 1400%. So, at least for the US markets, after the war, in the post-war phase, there is a strong market rally. Now, you might say that, Prashant, this was data for US markets, and the US investors may have a different behavior and perceptions when it comes to war. Point taken. So, I also looked at the data for India when we were fighting the Kargil war. Now, if you look at this graph on your screen again, when the war started in May 1999, the Indian stock market actually gave a rally. Till the time the war ended, that was around August and September, the markets had given a strong rally. So the Indian markets and Indian investors also have a similar reaction when it comes to stock markets at the times of war. And in the Kargil war, at least, we saw that the stock markets had a positive outcome. So to conclude this discussion, let us see how the stock markets move at various phases in the war as per the discussion that we have had in the video earlier. In the normal world, the stock market has normal ups and downs as it is normally. Then the inciting event happens and the stock market sees a downward movement. But this downward movement is not very deep and the recovery is rather early. Within 70 days, the market recovers back to its original level. When the war actually outbreaks, there are two things that can happen. The markets might actually move up if the war had an extended pre-war phase, or it might move down if the war outbreak was sudden. Once the war is over, the markets in the post-war phase always rally. So we can draw one interesting insight from this graph, and that is a long-term investor should not have much to worry about at times of war. In fact, in the pre-war phase, when the market declines, it presents a wonderful opportunity for the long-term investor to invest in quality stocks, because sooner than later there would be a post-war rally and the prices of stock market would increase drastically. So what should an Indian investor do right now? Number one, buy fundamentally good stocks at dips. Now, what are fundamentally good stocks? Number one, they should be established businesses with good management. Second, cash generating businesses with high ROCE and high profits. And finally, they should be available at attractive valuations. Number second, do not buy lump sum and invest in the SIP format. Now, this achieves two things for the investor. Number one is what we call rupee cost averaging. So, understand that despite what we have discussed so far, there will always be a lot of uncertainties during the times of war. And no one really knows how long would be the pre war phase or how long would the war last and when exactly would the market start rallying. So, to completely leverage this situation, do not invest all your amount at once, but invest in SIP formats. The second thing it achieves is that the investor will always have some amount of cash handy with them. So whenever there are stocks which are available at very attractive valuation, if you have cash, you will be able to leverage that cash and buy those stocks at attractive valuations. So always invest in the SIP format. Number three, hold your stocks for long term. Why? Because post-war, there would be a post-war rally and you can only make use of this rally if you hold the stock. So invest for long term, invest in good quality stocks. Now, are there some stocks which are available at low valuations? Yes. So look at some of these good quality stocks that are available at their 200-day average. For example, Hindustan Unilever, HDFC Life, Nestle and Asian Paints. Now all these stocks are good quality stocks available at lower than their 200-day moving averages. Now this is not a stock recommendation and you should always consult your financial advisor before you invest in these stocks. And this was only for an educational purpose. I hope you found this video very informative. Please let me know in the comments. Please like and subscribe so that we can stay connected. Hope to see you in the next video. Bye-bye.